If you think the recent market drop means the financial world has stopped making sense, you are looking at the wrong thing. Most people were taught a childish version of investing. They were told that when fear rises, money runs into safe havens, stocks fall, bonds protect you, stocks fall, gold protects you, stocks fall. Cash waits quietly in the corner until the storm passes. Then a real liquidity event arrives, and they watch stocks fall, bonds fall, gold fall, crypto fall, and almost everything they own gets dragged down at the same time. That is when they feel betrayed by the market. I do not feel betrayed by it. I understand what it is doing. When you live in a debt-driven system, the first law of a panic is very simple. In the short run, everything that can be sold gets sold, not because it is bad, not because it stopped being valuable, but because someone somewhere needs cash more than they need judgment. That is what most people still do not understand about the stock market decline in 2026. They keep staring at the headlines about war, oil, recession, stagflation, and fear. Those things matter, but they are not the deepest layer of the story. The deeper layer is leverage. The deeper layer is debt. The deeper layer is that we built a financial world that can only remain calm when asset prices, wages, and tax collections keep climbing high enough to service all the promises that have already been made. Once you understand that, the market stops looking random, then you can stop reacting like prey and start thinking like an owner. I want to be blunt with you. We are not living in a clean, healthy, cash-funded system. We are living in a system built on obligations stacked on top of obligations, government debt, mortgage debt, auto debt, credit card debt, student debt, corporate debt, margin debt, private and public liabilities, layered together until the entire structure depends on one thing: continuing inflation. That word bothers people because they hear it as a moral insult. I do not use it that way. I use it the way an accountant should use it. As a mechanical fact, a debt-heavy system needs nominal growth. It needs the price of assets to rise. It needs wages to rise. It needs tax receipts to rise. It needs the denominator of old debts to be slowly diluted by larger nominal incomes and larger nominal cash flows. Without that process, debt gets heavier rather than lighter. Then trouble arrives much faster than most people expect. Let me put it in plain English. Suppose you buy a house and you take out a $300,000 mortgage. Suppose your household earns $100,000 a year. That debt may feel manageable. It may not be comfortable, but it is serviceable. You can live with it, you can plan around it. Now imagine nothing changes about the mortgage, but your income drops to $70,000 a year. The debt did not grow, the burden did. The exact same promise becomes much harder to carry because your ability to carry it got smaller. Now run the exercise in the other direction. Imagine the same mortgage, but your household income climbs from $100,000 to $100,000. The house note did not get kinder. Your income simply inflated around it. Suddenly, the same debt feels easier, not because the lender was generous, but because time, wages, and price levels did part of the work for you. That is the secret most people miss. In a debt-saturated system, nominal growth is not a luxury. It is a pressure valve. If that pressure valve fails, then every fragile part of the system starts to show itself. That is true at the level of a family. It is true at the level of a business. It is true at the level of a country. And it is true at the level of the global financial structure. Over the last quarter century, sovereign debt did not drift higher. It exploded. Household debt did not stay flat. It piled up. Investors did not become more conservative. Many of them borrowed to buy even more assets because borrowing works beautifully in rising markets right up until the moment it does not. That is where margin debt enters the story. I want you to understand this clearly because without it, the sell-off makes no sense. If I have $1 million in a brokerage account, I can buy $1 million worth of assets. That is ordinary investing. But if I borrow against that account and I buy more than I actually own with my own capital, I have introduced leverage. If prices rise, leverage flatters my intelligence. It makes me feel shrewd. It makes my returns look larger. It can tempt me into believing I have discovered some deep secret when I have really just rented more exposure. But leverage carries a hidden condition. It only feels smart while prices cooperate. If markets stall, I am paying interest on borrowed money while my assets sit there doing nothing for me. If markets fall, the problem becomes more serious. My equity cushion shrinks. My broker does not care about my opinion, my long-term thesis, or my optimism. My broker cares about repayment. If the numbers move far enough against me, I get a margin call. That phrase sounds technical. It is not technical. It is brutal. It means you must produce cash Quickly, when enough people reach that point at the same time, the market stops being a voting machine about value and turns into a fire escape. And in a fire, people do not calmly carry out the furniture they love most. They grab whatever they can move fastest. That is why in a genuine liquidity crunch, investors sell what they can, not what they want. If a man owns a rental property, some stocks, some bonds, and some physical gold, and he needs cash in 48 hours, the rental property is not helping him. He cannot turn a building into immediate liquidity on command. But he can sell securities, he can sell liquid metals. He can sell the best thing in his account just as quickly as the worst thing. So the liquidation spreads, stocks fall, bonds fall, gold falls, treasury positions get trimmed, crypto gets hit, not because all of them suddenly became worthless, but because a leverage system can briefly turn every liquid asset into collateral for survival. That is what many people misread in 2026. They assumed the decline itself proved that nothing was safe and nothing worked. I draw the opposite lesson. I see a system coughing up leverage and demanding cash. Once you know that, you stop being shocked by broad selling. You also stop making the rookie mistake of thinking the move tells you what the long-term value of every asset must be. It does not. It tells you who is desperate. That is a very different signal. The conflict that hit markets at the end of February frightened investors for understandable reasons. Higher oil prices are not trivial. Oil runs through transportation, manufacturing, agriculture, logistics, aviation, chemicals, and increasingly through every layer of the AI build-out because energy is the hidden input behind almost everything. Recession fears were not irrational. Stagflation fears were not irrational. A geopolitical shock landing on top of a heavily indebted financial order was always going to create a messy reaction. But the market reaction became more violent because the system was already leveraged. That matters. I want you to keep separating trigger from structure. The trigger was geopolitical. The structure was financial. The trigger shook confidence. The structure determined how far forced selling could travel. Now, let me take you one level deeper because this is where most investors either become adults or stay children forever. If the immediate panic cools and the liquidity squeeze eases, what does the system want to do next? It wants to go back to inflation. That is the default setting, not because policymakers are villains sitting in a secret room cackling over currency dilution. They do not have to be villains. Arithmetic does the job for them when debt loads become enormous. The menu gets smaller. Authorities can tolerate slowdowns for a while. They can tolerate pain for a while. They can even tolerate brief recessions. But they cannot tolerate a long period of falling prices, falling wages, falling tax collections, and collapsing asset values without eventually reaching for the printing press, the fiscal pipe, or both. Why? Because the numbers stop working. A debt bubble does not coexist comfortably with long-term deflation. The burden rises in real terms. Tax revenue weakens. Defaults spread, asset values decline. Confidence collapses, lenders harden, borrowers crack. Then the authorities are left with two choices. They can permit a cleansing collapse that destroys huge chunks of wealth and political stability, or they can intervene with new liquidity and new money. History suggests they choose intervention, not every day, not in a straight line, not with perfect timing. But when the structure is threatened badly enough, they choose survival over purity. I learned a long time ago that you do not need to love the monetary architecture you live under in order to invest rationally inside it. You do not need to applaud it. You need to recognize it. I do not invest according to the world I wish existed. I invest according to the incentives, pressures, and reflexes of the world I actually inhabit. And the world I inhabit is one where too much debt exists for the authorities to sit comfortably with prolonged contraction. That means if the immediate war scare de-escalates and the liquidity scramble cools, the larger trajectory reasserts itself, debt expands. Money supply expands, asset prices recover over time. The nominal economy tries to climb because the system needs it to climb. That does not mean there will be no pain. It does not mean every stock is safe. It does not mean you can buy anything at any price and call yourself an investor. It means the broad monetary tide still pushes in one direction over long stretches, up in nominal terms. That matters enormously for how you should behave after a drop. Most people get this wrong because they treat investing like weather forecasting. They want certainty. They want to know whether they have bought the exact bottom. They want to move all in on Tuesday and all out on Thursday. They want the market to tell them they are clever immediately. That is not my game. I do not need the exact bottom. I need a favorable position in a system that is structurally biased toward larger nominal asset values over time, interrupted by violent corrections that periodically transfer ownership from the emotional to the patient. That is why my first principle in 2026 is simple: stay invested, not recklessly, not blindly, not with borrowed money hanging around your neck. But stay invested. If you keep jumping in and out because headlines scare you, you are doing the market's work for it. You are volunteering to turn volatility into permanent damage. I have seen too many people spend their whole lives trying to avoid temporary declines, only to miss the compounding that actually builds wealth. You do not get rich by being absent from productive assets every time the world looks ugly. You get rich by owning good assets long enough for the ugly stretches to become footnotes. So I do not want you thinking like a trader. I want you thinking like an owner. If a broad decline gives you lower prices on sound businesses, diversified funds, or real monetary insurance, that is not punishment. That is an offer. The second principle is just as important: buy the dip, but do not try to perform surgery with a butter knife. In other words, do not obsess over perfection. I have never met the investor who could consistently buy the exact bottom, sell the exact top, sleep peacefully, and keep doing it for decades. What I have met are disciplined people who keep adding during weakness, who keep their standards, who average irrationally, and who refuse to let short-term fear bully them out of long-term ownership. Cost averaging sounds almost too simple, which is why intelligent people often ignore it. They want something more exotic. But simple is not the same as weak. Simple can be powerful when it matches the structure of reality. If prices are lower than they were, and your time horizon is measured in years rather than afternoons, spreading purchases through volatility can remove the vanity from the process. You do not need heroics, you need endurance. The third principle is the one people ignore until the market humiliates them. Do not borrow an excessive amount of money to invest. Leverage is a wonderful servant during calm seas and a savage master during storms. It tempts smart people because it amplifies correct decisions. Then it ruins those same people because it removes their freedom to wait. And waiting is often the most valuable privilege an investor has. If I own something high quality and it falls, my advantage is that I can keep holding, keep thinking, and even keep buying. If I am over-leveraged, I lose that freedom. I become a forced participant in the dumbest part of the cycle. I become a seller when prices are weak. I become someone else's source of opportunity. You should never build a life where a market downdraft can force you to liquidate the very assets you intended to own for the long run. That is not investing. That is renting confidence from your broker until the bill arrives. The fourth principle is diversification, but I do not mean the fashionable version where a man owns 50 mediocre ideas and calls that prudence. I mean intelligent diversification across the main forms of resilience that matter in this environment. I would not want all my money in a single basket, a single sector, or even a single country. An S&P 500 fund or broad U.S. equity exposure remains essential to me because America still houses extraordinary productive businesses. It is still home to innovation, profitability, and scale. I do not want to bet against that, but I would not put every dollar into domestic equities and pretend that concentration is conviction. International exposure has a place. Other economies matter. Currency regimes, shift valuations differ. Opportunity rarely confines itself to one flag forever. And I would own precious metals. I know that sentence irritates people who worship only productive assets. I understand the argument. Gold does not invent semiconductors. Silver does not launch software. Neither one compounds through retained earnings the way a good business does. But that is not their job. Their job is different. Their job is to sit outside the liability structure of the system. Their job is to remind you that when money itself is being diluted to hold together too much debt, there is a difference between being rich in nominal numbers and being protected in real purchasing power. You can dislike that truth and still be punished by it. When I look at decades of monetary expansion, I do not become more hostile to productive businesses. I become more determined to own both productive assets and monetary insurance. The mistake is not choosing one category. The mistake is pretending you only need one. Over long stretches, more money exists, more currency units chase goods, services, assets, and scarce stores of value. That process is visible in money supply. It is visible in stock indices over time. It is visible in gold over time. It is visible in the way people slowly discover that cash is not neutral when the unit itself keeps changing. This is why I find it strange when investors frame gold as irrational and then celebrate equity indices rising inside a monetary system built on expanding liquidity. Both moves are telling you something. One expresses faith in productive enterprise. The other expresses distrust in the measuring stick. I do not see a contradiction in owning both. I see maturity. Now let me tell you the most important thing of all. Do not confuse short-term correlations with permanent truths during a crunch. Gold can fall because it is liquid. Bonds can fall because rates, inflation fears, and liquidation pressures are colliding. Stocks can fall because growth expectations weaken and forced sellers need cash. When people watch that and conclude that no asset works, they usually arrive at the most dangerous destination of all: cash, absolutism. They decide the only answer is to sit out everything, to wait for certainty, to wait for the all clear, to wait until the sky is blue again and every risk has already been repriced by people braver than they were. But waiting for certainty in a debt-driven inflationary architecture usually means paying a higher nominal price later. That is why your framework matters more than your mood. If you believe the system is broken but still biased toward monetary expansion, you do not hide from every correction. You prepare for them, you keep liquidity for them, you use them to improve ownership rather than to abandon it. If you believe policymakers will tolerate endless deflation, endless contraction, and mass liquidations without eventually intervening, then your behavior should be different. But I do not believe that. The incentives do not point there. The math does not point there. The history does not point there. So my behavior follows what I regard as the stronger probability. I stay invested in productive assets. I add during weakness. I keep debt under control. I diversify intelligently. I own monetary insurance. And I never forget that a temporary liquidity scramble can produce very foolish prices in both directions. The people who win in that environment are not the ones who sound smartest on the day of the panic. They are the ones who arrive with a plan that already assumed panic would come. I want to touch one more nerve before I finish, because this is where many people lose the plot. They think the mission is to avoid volatility. It is not. The mission is to survive volatility without being forced into bad decisions. That sounds like a small distinction. It is not. It is the whole ballgame. Volatility by itself is not fatal. Forced selling is fatal. Over-leverage is fatal. Concentration in fragile assets can be fatal. Confusing price with value can be fatal. Building your life around the assumption that the market will stay polite can be fatal. But volatility, when met with liquidity, patience, and sound position sizing, becomes something else entirely. It becomes a transfer mechanism. It moves assets from people who must sell to people who are able to buy. That is why I want you to think very carefully about your posture in 2026. Are you arranged to be a victim of the next downdraft or a beneficiary of it? If another wave of selling arrives, will you be the person staring at your screen trying to protect borrowed money? Or the person quietly adding to quality with cash you deliberately left uncommitted? Will you be the person praying for prices to recover before your finances crack? Or the person hoping good businesses get even cheaper because you know what you own? That is the test. Not your opinions about politics, not your ability to repeat a macro forecast, not whether you can sound impressive at dinner. The test is whether your financial structure lets you act like an owner when everyone else is acting like prey. So here is my closing judgment. The drop in 2026 scared people because it looked like all the old protections had failed at once. Stocks were down, bonds were down, metals were hit, crypto was hit. Fear spread faster than explanation, but I do not think the deepest lesson is that the world stopped making sense. I think the deepest lesson is that too many investors still do not understand the plumbing beneath the market. They see the smoke and miss the leverage. They see the liquidation and miss the debt burden. They see the falling prices and miss the larger system's need for inflation, nominal growth, and rescue. Whenever contraction goes too far, that misunderstanding is expensive. I would rather be uncomfortable with the truth than comforted by a fairy tale. The truth is that we live in a debt-heavy world where authorities can tolerate pain, but not endless cleansing. The truth is that leverage can force good assets lower in the short run. The truth is that selling pressure often says more about balance sheets than about value. The truth is that diversified owners of productive assets and real monetary hedges are still better positioned than frightened spectators holding a shrinking measuring stick. And the truth is that if you can keep your head while other people are selling what they can, you will very often buy what they later wish they had kept. That is how I would invest after a market drop in 2026. Not with panic, not with heroics, not with borrowed bravado, with structure, with patience, with ownership, and with a very clear understanding that in a world drowning in debt, the biggest long-term risk is not volatility. It is being left behind while the currency unit keeps getting weaker and the ownership of real assets keeps getting tighter in stronger hands. That is the choice in front of you. You can spend the next panic asking why everything fell, or you can prepare now so the next time everything falls, you already know exactly what to do.